Usually, well, when you decide to learn a new language, you start with the absolute basics. You learn how to say hello or how to ask where the train station is.
Right, exactly. You don't just jump into the deep end.
Yeah. It's a structured progression. You don't parachute into a busy intersection in Tokyo and, immediately try to negotiate a complex business
I
contract.
mean, that would be a recipe for a very expensive headache.
Totally. But when you look at financial markets, that is precisely the experience most people have. You check your retirement account, or, you turn on the business news, and suddenly you're drowning in this hyper-specific vocabulary.
Oh, the jargon is everywhere.
Right. Market cap, yield to maturity, enterprise value, contango, it just feels like an impenetrable wall of noise.
And because it sounds so complex, the natural human reaction is to just, well, tune it out.
Yeah, exactly.
People tend to either cross their fingers and hope their investments do well, or they just hand their money over to whoever sounds the most confident using those big words.
Which is exactly what we are going to fix today. Welcome to the deep dive. We are taking a machete to that dense jungle of financial jargon.
We really are.
Specifically, we're decoding the terminology of the equity and debt markets straight out of Chapter 3 of the NISM Research Analyst workbook.
It's such a crucial chapter.
It really is. So whether you are actively managing your own portfolio, prepping for a major financial meeting, or just want to, finally understand what the analysts are arguing about on television, mastering this vocabulary is the ultimate shortcut.
Absolutely. You won't just hear the noise anymore. You will actually understand the mechanics of the conversation.
So set the stage for us. Where do we even begin?
Well, to set a baseline for you, consider what happens when any business needs capital.
Okay.
Let's say a company wants to build a new factory or expand into a new country. They face a fundamental crossroads with two very distinct paths. They can issue equity or they can issue debt.
The big divide.
Right. The financial world splits almost entirely down this line.
Yeah.
And the terminology on each side reflects a completely different philosophy of money.
I love that. Let's talk about that philosophical difference before we even touch a single mathematical formula.
Let's do it.
I always try to visualize equity like starting a local restaurant with a few friends. You all pool your money together and you share the risks.
Right. You're all in the same boat.
Exactly.
Huh.
If the restaurant goes under, you lose everything you put in. But if it becomes the hottest dining spot in the city, you share in that massive, limitless upside. You are owners.
Yeah.
Debt, on the other hand, well, that feels more like going to the bank for a loan to buy your commercial ovens.
That captures the dynamic perfectly.
Right.
To build on that restaurant analogy, the bank lending you the money for those ovens,
What?
they do not care if you become a millionaire.
Right. They just want their monthly check.
Exactly. They are lenders, not owners. They accept a much lower potential return in exchange for periodic fixed interest payments.
That makes sense.
And crucially, they get priority repayment. If your restaurant goes bankrupt, the bank gets to sell off those ovens and take their money back before you, the equity owner, see a single dime.
Okay, let's unpack this, starting with the equity path. Since equity is entirely about ownership, the very first thing you want to know is what that ownership is actually worth.
Obviously.
But when you look closely at the terminology in the NISM workbook, value is not just a single straightforward number. There are all these multiple faces of value, which feels, frankly, unnecessarily confusing.
Oh, confusing them is a trap a lot of new investors fall into, so let's separate them. The most basic one is face value.
Okay.
This is just a nominal accounting price for a single share. It's often a tiny number, like 10 rupees.
Just a placeholder, basically.
Pretty much. It sits on the company's books and almost never changes unless they deliberately split the stock. It tells you absolutely nothing about what the company's actually worth today.
So we can basically ignore face value when we are looking to actually invest.
Yeah, for the most part.
What about book value? That one sounds a bit more grounded.
It is more grounded, but it looks backward. Book value is essentially the company's net worth on paper.
Okay, how so?
Think of it like this. If you took everything the company owns, like cash, factories, inventory, and used it to pay off every single debt they owe, book value is whatever cash is left over.
So it's the liquidation value, sort of?
Essentially, yes.
Yeah.
You divide that leftover cash by the number of shares, and you have the book value per share.
But wait, that is based on historical costs, right?
It is.
Like if they bought a piece of real estate 50 years ago, book value might just show what they paid for it back then, not what it's worth today.
Precisely. Which brings us to replacement value. This metric asks a theoretical question. If you had to recreate this exact company from scratch today, buy the land at today's prices, build the factories, hire the talent. What would that cost?
Oh, wow. So it's like rebuilding it from the ground up.
Exactly. It's a way to measure the physical reality of the business. And then finally, you have market value.
That's the one we all see on our screens.
Right. That is simply the current trading price multiplied by the number of shares. It is whatever the crowd of investors is willing to pay right this second.
See, I have to challenge this, though.
Go for it.
If the stock market is open and millions of highly motivated people are trading shares back and forth, the market is giving us a real-time price every single second.
Right.
So why do we need theoretical numbers like replacement value or book value? Shouldn't market value be the only number that really matters?
Well, if human beings were perfectly rational calculating machines, yes. But the market is driven by human emotion.
That's fair.
It oscillates violently between fear and greed. I mean, a bad news headline can tank a stock's market value in minutes, even if the actual business hasn't changed at all.
True.
And this highlights the most crucial concept in equity investing, intrinsic value.
Meaning what the business is actually mathematically capable of producing, regardless of how the stock market feels about it today.
Exactly. The workbook specifically cites Warren Buffett on this. Think of intrinsic value as the discounted value of all the cash that can be taken out of a business during its remaining life.
The cash flow.
Right. The entire art of equity investing is the pursuit of finding the divergence between market value, or what the panicked or euphoric crowd thinks the business is worth, and intrinsic value.
What the business is truly going to generate over time.
Exactly. You are constantly looking to buy when the market's price tag is significantly lower than your calculated intrinsic value.
Okay, so if our goal is to find that gap between the crowd's emotion and the mathematical reality, how do you actually measure it? Like we hear about enterprise value or EV constantly. How does that differ from just looking at a company's total market cap?
It helps to think about acquiring a business the same way you might think about buying real estate. Imagine you're buying a house.
Okay, let's say I see a house listed on the market for $500,000. In stock market terms, that $500K is the market cap, right? The sticker price.
Yes, that's what the market says it's worth right now. But what if you find out the previous owner still has a $100,000 mortgage on that house that you are legally required to take over when you buy it?
Oh, I see. Then my true cost isn't $500,000, it's $600,000 because I have to pay the seller and eventually pay off that debt.
Right. But wait, what if you also discover that the previous owner left $20,000 in cold, hard cash locked in a safe in the basement, and the contract says you get to keep anything inside the house?
Nice. Then I can use that $20,000 to immediately pay down my costs. So my real out-of-pocket cost is the $500K sticker price plus the $100K mortgage I take on minus the $20K in cash I found. So $580,000.
That is enterprise value.
Wow. Okay.
It's the market value of the equity plus the market value of the debt minus the cash sitting in the bank.
That makes perfect sense.
EV tells a potential acquirer what it would actually cost to swallow the entire functioning business whole. It gives you a much truer picture of the company's scale than just looking at the stock price.
That makes the math feel so much more tangible. Now, what about the classic multiples everyone talks about, like the PE ratio or price to earnings?
Right, the most famous one.
This is essentially how much you are paying for one unit of the company's profit, right? If a company has a PE of 20, you are paying $20 for every $1 of profit they generate.
Exactly. And you have to be careful with PE because looking at past profit, a trailing PE might not tell you much about the future.
Forward PE versus trailing PE.
Exactly. But relying entirely on PE can be dangerous for another reason entirely. What if a company is rapidly expanding, taking over market share, but temporarily operating at a loss?
Well, then their earnings are negative. So a price to earnings ratio would be a negative number, which is, mathematically useless for comparing them to other companies.
Right, and that is where price to sales, or PS, comes in.
Okay.
Instead of looking at profit, it compares the stock price to the company's top-line revenue. It is a crucial metric for evaluating companies going through a phase of negative profits.
Like early-stage tech platforms.
Yes, or aggressive retail startups, where you want to value their growth and market share before they turn the profit engines on.
But if they are profitable, you also don't want to overpay just because they have a solid PE. That is where the PEG ratio comes in, right? Price earnings to growth.
Spot on.
It adjusts the PE ratio by factoring in how fast the company's earnings are expected to grow. A high PE might actually be a bargain if the company is growing at lightning speed.
It contextualizes the price tag. You are willing to pay a higher multiple today if you know the earnings are going to double tomorrow.
There is one nuance in the equity terminology from the workbook that I find genuinely surprising. Differential voting rights, or DVRs.
Ah,
The
yes.
idea that a company like Tata Motors or Pantaloons can issue shares that deliberately give you fewer voting rights than a normal shareholder.
Yeah.
Like, why would anyone voluntarily buy a stock that silences their voice in the company?
What's fascinating here is that different investors want entirely different things.
Us.
Well, a massive institutional investor, like a hedge fund, might care deeply about voting rights so they can force the board of directors to change strategy.
Right.
But you, as an individual retail investor, you probably aren't planning to fly out to the annual general meeting to cast your one vote. You just want a financial return.
That is a fair point. I really just want the stock to go up.
Exactly. So companies issue these DVRs at a slight discount. And to compensate for stripping away your voting power, they usually offer a higher dividend.
Oh, interesting.
It is a brilliant trade-off. The founders keep tighter control of the voting block, and passive investors get slightly higher cash payouts.
It's basically a menu of options based on what you actually value.
Exactly.
All right, let's leave the infinite upside and growth multiples of the equity world. I want to flip to the other side of the balance sheet.
The debt market.
Right. For people who prioritize certainty and time, we enter the world of debt. Let's decode some bond jargon. When you buy a bond, you are the lender, and you encounter terms like face value, maturity, and coupon rate.
Yes. The structure of a bond is rigid. The face value is the principal amount you are lending the company, say, 1,000 rupees.
Okay.
The maturity is the exact date in the future that they are legally obligated to hand that 1,000 rupees back to you. And the coupon rate is the regular fixed payment they make to you along the way, expressed as a percentage of that face value.
I have to stop you there and ask a basic question that trips a lot of people up. Why do we call it a coupon?
It's a funny word, isn't it?
It is. When I think of a coupon, I think of like a piece of paper that gets me 50 cents off a box of cereal. Why don't we just call it an interest rate?
It is a vital distinction in finance. Historically, paper bonds actually had physical tear-off coupons attached to the bottom of the certificate.
Wait, literally?
Literally. Every 6 months, you'd actually clip one off with scissors, walk into a bank, and trade it for your cash payment.
That is wild.
Today, it's all digital, but the term remains because a coupon is a fixed, unchanging percentage locked to your specific bond. The term interest rates, however, refers to the broad, fluctuating market rates controlled by central banks.
Ah, so the coupon is your specific contract. The interest rate is the weather of the entire economy.
Beautifully put. And that distinction leads to the absolute golden rule of the debt market.
Whoa.
The inverse relationship between market interest rates and bond prices.
Okay, yes.
When market interest rates go up, the value of existing bonds goes down.
Here's where it gets really interesting, because I know this inverse relationship scrambles people's brains. Why would my bond lose value just because the central bank changed a number?
Let's walk through the logic.
Yeah, let's say I buy a 10-year bond with face value of 1,000 rupees and a coupon of 8%. Every year, I reliably get 80 rupees. I'm happy.
Right.
But a year later, the central bank raises rates to fight inflation. Now, any brand new bonds being issued by that same company have to offer a 9% coupon to attract investors. So they pay 90 rupees a year.
So consider your position. What happens if you suddenly need cash and you want to sell your old 8% bond to another investor?
They are going to laugh at me. Why would they pay 1,000 rupees for my bond that only pays 80 a year when they could just take that same 14 rupees and buy a brand new bond that pays 90?
Exactly. To attract a buyer, you have to sweeten the deal. You have to lower the price of your bond.
So I have to take a loss on the principal.
Right. You might have to sell it to them for, say, 920 rupees instead of 1,000. By paying less up front, the new buyer's overall percentage return, combining that 80 rupee coupon and the discount they got on the price, will roughly match the new 9% market reality.
Wow.
The fixed cash flows of your bond never changed, but its market price had to drop to adjust to the new environment.
That is the light bulb moment. Because bond prices constantly fluctuate with these interest rate shifts, lenders need highly sophisticated ways to measure their actual returns over time. It's not just about looking at the coupon.
No, not at all.
That brings us to yield to maturity, or YTM.
Yes. YTM is the metric you use to compare different bonds on an apples-to-apples basis. It calculates your true internal rate of return, factoring in the coupon, the price you paid, and the time left to maturity.
Okay, sounds perfect.
But YTM comes with two massive assumptions that you have to be acutely aware of. First, it assumes you never sell And you hold the bond to the very last day of maturity.
Which doesn't always happen.
Exactly. And second, it assumes that every single coupon payment you receive along the way is immediately reinvested at that exact same YTM rate.
Wait, that second assumption seems flawed. If I get an 80 rupee coupon payment 5 years from now, I have no idea what the market interest rates will be at that time. I might not be able to reinvest it at 8%.
Which is exactly why YTM is a theoretical maximum. It represents a perfect, uninterrupted mathematical scenario that rarely plays out perfectly in the real world.
Interesting. And to measure how terrifying those interest rate shifts can be to your portfolio, analysts use a metric called duration, right? Specifically, modified duration.
Yes.
It literally measures a bond's price sensitivity to interest rate changes.
Think of duration as a measure of risk. The longer you have to wait to get your principal back, the higher your duration, and the harder your bond's price will swing when the central bank changes rates.
Okay, now you don't just have standard vanilla bonds where you collect a coupon for 10 years. The terminology gets much deeper based on the flavor of debt. Let's look at a few unique mechanisms mentioned in the text.
Sure.
First, zero coupon bonds. These pay absolutely zero interest along the way. Why would anyone want that?
Because you buy them at a deep discount. You might pay 700 rupees today for a bond that will mature at 1,000 rupees in 10 years.
Oh, I see.
The Kisan Vikas Patra in India operates on a similar deep discount principle. Investors like them because there is no reinvestment risk along the way.
Right. You don't have to worry about finding a place to put those 80 rupee coupon payments every year.
Exactly. You just lock it in and wait for the big payout at the end.
Then you have perpetual bonds, which sound like an oxymoron. A bond with absolutely no maturity date. The issuer never actually promises to pay back your principal. They just pay the coupon forever.
Yes, forever.
Why would I lend a bank money if they tell me up front they are never giving the principal back?
You would only do it if the coupon rate they offer is significantly higher than a normal bond. Investors hungry for yield will take that deal. Banks love issuing these, often called AT1 bonds, because it allows them to raise capital to meet strict regulatory requirements without having to dilute their equity by issuing more shares.
Fascinating. What about principal protected notes, or PPNs? The name alone sounds like a magic bullet. I get the upside of the stock market, but my principal is 100% protected. How does that mechanism actually work?
It's clever financial engineering. A PPN is a synthetic mix of debt and derivatives. Essentially, the issuer might take 80% of your money and buy a very safe zero-coupon bond that is guaranteed to grow back to 100% of your initial investment by maturity. Then, they take your remaining 20% and use it to buy aggressive stock market options. If the options fail, you still get your principal back from the bond. If the options hit, you share in the upside.
But the danger there, and this is a vital warning for you listening, is that principal protection does not mean guaranteed by the laws of physics.
Far from it. You are still completely exposed to credit risk. If the financial institution that structured the PPN goes bankrupt, that protection vanishes instantly. You become an unsecured creditor fighting for scraps.
Yikes. Okay, finally, we have to talk about masala bonds, because this highlights how currency risk can just ruin an investment. If an Indian company borrows money in US dollars and the rupee suddenly loses value against the dollar, paying back that same loan suddenly costs the Indian company vastly more rupees.
Right. It can bankrupt an otherwise healthy company. If we connect this to the bigger picture, a masala bond solves this.
How?
It is a rupee-denominated bond, but it is issued overseas to foreign investors. The borrowing is locked in rupees. If an investor in London buys a masala bond and the rupee drops in value, the London investor takes the hit on the exchange rate when they convert their coupon payments back to British pounds.
That's brilliant.
It is. It brilliantly shifts the entire currency risk from the Indian issuer to the foreign investor.
It is a phenomenal tool for shifting risk. Okay, we have covered the paper claims of equity and debt. We're going to make one final logical step into the physical constraints of the real world, commodities.
A completely different beast.
We're talking gold, wheat, crude oil. The terminology here shifts because we are no longer dealing with concepts, we are dealing with atoms. First, the spot price.
The spot price is straightforward. It is the exact price you pay for immediate physical delivery of the commodity today. You hand over the cash, they hand over the barrel of oil.
Simple enough.
But commodity markets are heavily driven by futures contracts, agreeing today on a price to buy or sell something months from now. And the relationship between the spot price and the futures price gives us two vital terms, contango and backwardation.
Contango sounds like a dance move, but it actually describes a very frustrating reality for investors. It's when the futures price is higher than the current spot price. Why does this happen?
Because of the cost of carry.
The what?
A bond or a stock doesn't take up any physical space. But if you buy 10,000 barrels of oil today, you have to rent a specialized storage tank. You have to pay for insurance. You have to pay for security.
Ah, of course. Real-world costs.
Right. The futures price bakes in all those physical holding costs.
Yeah.
It is more expensive to contract oil for delivery in 6 months because someone has to pay to store it until then.
And backwardation is the reverse mechanism. It's when the futures price is strictly lower than the spot price. Why would I pay more for oil today than what I can lock it in for 6 months from now?
Usually because of a sudden shock or a supply disruption. What stands out to you when you think about an emergency? If a major pipeline breaks and your factory needs oil today to keep the machines running, you don't care that oil will be cheaper in 6 months.
You just need it now.
Exactly. You will pay a massive premium to get it right now. Backwardation indicates the market expects the current shortage to resolve and prices to fall in the future.
It really grounds all the financial math in physical reality. So let's pull all of this together. We have journeyed through the primary kingdoms of capital.
We covered a lot of ground.
We really did. Equity is the language of ownership, of intrinsic value, and of balancing limitless upside against the risk of losing it all. It speaks in metrics like enterprise value and PEG multiples.
Right.
Debt is the language of time, of fixed contractual yields, and of extreme sensitivity to macroeconomic interest rates. It speaks in coupons, YTM, and duration. And commodities introduce the undeniable friction of physical storage and supply chains into our financial contracts.
Perfectly summarized.
So what does this all mean for you? Mastering this vocabulary is your ultimate armor. It stops you from being intimidated by a dense annual report. When you hear that a central bank is raising rates, you instantly know the mechanics of why the old bonds in your portfolio are dropping in price.
Exactly.
When you see a company with a negative PE, you know to switch your lens to price to sales. You are no longer just letting the financial noise wash over you. You are actually reading the market's true signals.
And I want to leave you with a final thought to ponder. We have spent a lot of time today dissecting precision.
We have.
Intrinsic value is mathematically based on predicting future cash flows over a company's remaining life. Yield to maturity relies on the strict assumption that you can perfectly predict the reinvestment rate for every future coupon.
Right.
But what happens to all these meticulously calculated, beautiful valuations when an unforeseen global event completely breaks our ability to forecast even 1 year into the future? When the models inevitably break, how much of our tightly grasped value is actually just an illusion of predictability?
That is a phenomenal question to end on. It turns out that the deeper we understand the language of finance, the more we realize how much of it relies on our fragile assumptions about tomorrow. Keep questioning the numbers, keep challenging those assumptions, and the next time you hear someone throwing around terms like enterprise value or contango, remember, you now know exactly how the mechanics work. Thanks for joining us, and we will catch you on the next deep dive.